All right. Good afternoon. We have Brian here, Brian Cheng, a new member, terrific new member here in a advanced coaching session. This is a private session, one-to-one. Today is July 30th, 2017, approximately 3:17 p.m. Eastern Standard Time. Full disclosure: this is purely for financial education and not for any solicitation or advice. And we shall begin. The session will be recorded and uploaded to the YouTube channel, and will only be available to you as a private ACS student. Good. So let's kick off, and we're going to, like I said, we want to keep this a little bit free form. But tell me what you're in a broader sense. Give me an idea of what you're trying to get out of the single sessions, because we're going to segment it down into different topics, and over the next in these three private sessions that we're going to do, I'm going to address each one of them in a very detailed manner, which is going to be very helpful to you. So in a broader way, what are you looking to do on what is yeah. So let me ask you that. Let me put that
Well,
in a question.
so since I've started trading options
Mm-hmm,
back
mm-hmm.
in 2005,
Go ahead.
I've been successful at times and not successful in other times. And I
Sure.
think
Mm-hmm.
the main caveat is, kind of like, as much as I've, followed technical analysis and taken the classes, it's getting to the nuances
Mm-hmm.
of what you do to be able to predict, let's say, okay, the market's topped,
Mm-hmm.
a stock is hitting its primary resistance, it's going to fall down,
Mm-hmm.
because I'll have profits. And I'm one of those guys where when I say, like, I'm a swing trader, maybe I'm a long swing trader where it might be months where I'd be holding a position. Yeah, I write out the dips,
Mm-hmm.
making really good money, but then it's like, well, I don't want to give that money back. And there
Mm-hmm.
are
Mm-hmm.
times where I do give that money back, and I'm like, why didn't I see the signs? Why didn't I see the signals?
Okay. So let me stop.
So
So let me stop you for a second. I know exactly what you're talking about. What you're talking about is a direct aspect of trade management, and what I call effective trade management. And effective trade management is not something that is a linear equation. It's not one plus one
mhm.
equals two. You have to be flexible. You have to basically use the tools that are in hand and go from there. So if I understand correctly, what we will cover in this session, and of course this is an ongoing thing. Remember, this is not like a wham bang, and I've never been like that. I'm always in the business of trying to really work with people as a personal coach, on a trading coach standpoint, and share what I do, what works, and what is very difficult for me too. Let's face facts here.
Mhm.
This is not online trading academy where they're going to give you a packaged bill of goods, and it's just going to be like, okay, if you do this, you're going to win, and if you don't do this, you're not going to win. It's not like that. Flexibility is key, and it's fluid. Okay. Now, if so, am I surmising this correctly as I'm listening to you?
Yes,
That's right.
yes, no,
Okay, good. So good. So now I know where I'm going with this. Okay, good. So this is what we're going to cover today. So one of the key things, when you're looking all these variant charts, each of them look quite different than each other, is that what I have found over many years, um, is that is that my trade management practices are enhanced and more effective in keeping my profit. That's really the simplest way I can describe it, in the bank, without, and this is the dichotomy that we all run through, is we sell, and then we see the same thing go up another 15 points, especially the big, high beta movers, and we're like, what the heck, man? Why, why didn't I hold it? But then at the other hand, and this is the paradox, that's the best way I can describe it, okay? On the other hand, if you held it, holding your nose, like you said, for weeks and weeks, the next thing you know, you go through a 30, 40 point dip, and you're like, what the hell? Why didn't I take the profits? You know what I'm saying? So in between this structured chaos, what I call structured volatility, And you're seeing an absolute depiction of that in a very simple. This is a very new chart that I drew on Friday, which was only since this chart is basically a week old, right?
Right.
And from the let me see here, from the 18th, yeah, a week old, and that you can clearly see that holding and just saying, okay, I'm going to buy and hold because I know it's going to go from here all the way to here is a fool's game. Because the fact is that it went from here to here, the first stage of that 24 to 48 hour reflex bounce that I always stick to, and then you get this big fat mini flash crashes, big volatility. This is sort of a medium-sized flash crash. Then you get these mini ones, and then it just rips up and basically gets up and creates a new high, and back and forth. So there is no one direct answer as to say that, okay, I'm going to buy this double barrel bullish engulfing reversal, which was very evident, and I highlighted that as a big buying opportunity. That was on the 18th. And just to put things in perspective, the 18th was Tuesday, not past Tuesday, but the Tuesday before.
Mhm.
And the biggest money is always made, and we're going to cover all this stuff within the first blast, which is the 24 to 48 hour move. This is exactly this. And then after that, it gets really messy. Well, that's what the outside world says. I look at it as pure structured, range volatility. And then eventually it gets to a higher level. But by the time we think it's going to break out a little bit more, because we are in a topping process. Let's keep that in mind, okay? And so you get a flash crash. I mean, that was an unadulterated, just wham bang. Started at 12 noon, straight down. Last what was it? Last Thursday, and was it Thursday? Yeah, 27th was. 27th was 27th was Thursday, exactly. And so there is no way in the world that it doesn't matter what technical analysis, how smart you are, what information you have, how well you can you hear me?
Yes.
Yeah, I just had a quick beep on my headset, so I wasn't sure if I muted you. So how alert you are about all the different noise that's coming out from different funds. There is no way in the world that you can chart these type of movements as we have clearly seen repeatedly. So in a very simplistic way, before we get into it, from a trade management standpoint, what I do and what works the best for me is the fact that I take the bulk of my profits on the first leg of the big move, and most of my profit will be taken pretty much around these levels or possibly around these levels, and I probably won't be there right till the end, which, by the way, we don't know it's the end, because this is, in hindsight, everything is 2020, and the way things were moving, it would be logical, and this is where the machinations and the manipulations of the high frequency traders come in, and they're not all cut from the same cloth. They're all different styles that are used. But whichever the case, this looked like a direct expansion up here, which we did get was that level that I kept on saying, except it didn't happen on the 20th. It happened a week later. And in between, like I say, we took a scenic route. So the best way and the most simplistic way that you need to basically manage that, when we get these type of classic short covering, high volume reversals, and you can see that in the form of these very powerful bullish engulfing candles. One second. Let me expand it so you can see it more. Hold on. See, that was the previous range, so I'm not even going there. This chart is extremely, we're going to spend a little bit of time on this because this chart is extremely relevant for this coming week, period. That's it. So bottom line is, when you get this massive bullish engulfing candle reversals right off here, that's why I shaded this chart. I'm sure you got a kind of a gist of what I was trying to show with this particular chart, multiple flash crashes and then movements higher. When you get this type of thing here, the fact is that you need to, within the first big wave, now to me it's almost gut instincts when that wave is starting and approximately where it's going to end. For you guys, you need to basically follow my charts very, very closely and the levels that I draw. But that first wave that came about was where I would take a good chunk of my profits, and then I don't like when it comes to candle dynamics, which is really what these charts are all about. That's really what the market is all about, Brian. Is I don't necessarily like shorting these mini pullbacks, which you're talking about. Look on the right here. We're talking about, let's say, 24.75 down to 24.72. For me,
Mhm.
a profitable short move would be of north of 6 to 8 S&P points, and you can see that clearly in the form of these candles. When I see the third candle develop, that's when I start to, here's the first one. This is the first real one. Then the second one, the third one, the fourth one. But you can basically, I look at it as a three candle move. That's when I know that there is something a little bit bigger than just a quick sell-off about to happen. Um, so coming back to the original question in your case, okay, the only way that you are going to, especially when you are looking to trade the SPX or looking to trade the Amazons or the Netflixes or things of that sort with heavy, heavy volatility. But let's stick to the S&P 500 here. In this case, it's the basically the futures we're looking at, the real proxy, or the what's happening in
Mhm.
the behind the kabuki theater, right? That's when the is the reality of the show. The point is that I wish I could give you a straightforward answer and say, hey, listen, there is definitively a way that you could buy this low and know that it's going to basically get up there. There is none. However, saying all that, when I highlight multiple, and this my job is to basically be a faster messenger of the market so you all can benefit. When I see multiple, and this is the second most viable answer to your trade management question, when I see multiple reversal candles off a certain level, you can clearly see here how defined it is, right?
Right.
And that was approximately off that 2463 level or so on the E-minis. You can see that that's where the broad red line is. At that point, you have a very high probability. You have a very high probability of swinging the trade for the next 24 to 48 or hours, but not more than that, because everything that's happening in the market right now is capsuled encapsulated within a 24 to 72-hour movement. There are no swings. Like swings mean, I'm not talking about individual stocks, mind you.
Right.
Okay, I'm sitting on a whole bunch of, we're going to talk about that on a further session. I'm sitting on a nice bunch of 8 to 10 biotech stocks that I normally don't, and some of them I trade actively, so I show it to you guys, but some of them I don't even look at, and they're just there. And those are the what do you call it, actual swing trades, but that's a totally different ball game. When you're looking to trade the S&P or the Russell 2000, which is far more volatile, literally 10 points up, 10 points down every other day. The S&P has a little bit more curvature to it, but the Russell 2000 literally is like this. We'll look at that too. There is no way in the world that you can basically say I'm going to just hold on to it and it's going to get there. There is no way of telling, regardless of my overall precision forecasting, what is going to happen over a period of beyond these tactical buys, which are very powerful entry points. What's going to happen after the first 48 hours? Because the reality of the situation is that this happens. Okay, so we're moving on here, and then everything is looking pretty solid. In fact, very solid. And then this happens. Okay. Now the other thing that is amplified during this period, as we get towards August, mid-August, is earnings. Earnings are going to basically dominate the flow, and that's something that you have to take into account. It's an added level of volatility that is normally not the case during post earnings. Okay, so just keep that in mind. So Amazon missing, and or some of one of the big boys, like missing the numbers, is going to affect your overall trade, regardless of regardless of what you're in. Period.
Right.
So when you're looking at it from a standpoint of a swing trade, you cannot swing, generally speaking. I'm not sure to say you can't. You certainly can, because my calls, for example, for on the S&Ps are for next Friday, but I know very well that by next Friday, and this was the close on Friday, and I am looking at this chart here, and I'm projecting certain things, and I showed you guys, and I wrote it in big letters that this was a pattern symmetry that I'm detecting. But there is absolutely no guarantee that we're not going to open up here, crash down, and then do another zigzag, and then get up towards a level which I think the market is going to go to, which is approximately around 2490 to 2500 on the S&P 500. So, saying all that, there's one way that I do it which works very well for me. If I have a strong conviction, as I'm monitoring my charts, and and of course a lot of it is gut feeling too, believe me, is the fact that we are going to get to this level, which is approximately 2500 on the S&P, because 2486, 2491 to 2500 in the S&P 500. Then I will buy my first lot, which I did, off the 2500 calls during this basing volatility, as you're seeing in front of you. Let me just change the color. I'm seeing an exact pattern here, which is very similar, and I think you're seeing that too. You're seeing the start of the breakout. You're seeing the start of the breakout, which is going to hit some resistances. That's why you have this the dotted green line as a resistance. You have the red line, which was the real breakout breakdown level back on Thursday on the 27th. Yes, Thursday on the 27th. Once we break out over that, there is going to be a very fast move again up towards the highs, which was the 2480 to 2481 level. And at that point, you're going to hit some major resistance. So my point is that I position myself at this level here, knowing very well that if I'm going to make, the biggest money is always made on the, like you correctly pointed out, on holding the swing. But like I like to remind everybody, and I want to basically, repeat that again. If you're not watching your screens, and you truly believe that these charts are, which I've proven over and over again, do work on a very high probability hit ratio, as I like to call it, then in that case, you cannot watch the screens. You cannot watch your P&L for the time period that we are going to, that it's going to take to get there. So in other words, I'm saying it is going to get there. But in order to get there, it is going to hit, it'll hit the first roadblock here. God knows what's going to happen. I can't predict the short-term volatility part. Probably it's going to come down here. What I do know, and this is what really helps me, is that if it drops back towards these extreme power quadruple and triple bottom, what I call long tail reversals, because they keep on hitting, and that's when the shorts cover and the buyers come in. So there's a very strong support here that I'm going to at that point buy more of my and lower my cost basis if I hadn't sold at these levels. Now my positioning is down here. So bottom line is that if I'm going to hit the first major resistance, which was the breakdown point, okay, and that's why these charts are drawn very, very clearly, the breakdown point here, then or even here, because this flash crash, very high probability from what I have experienced, and that's what I've traded these things so often. It's never easy, but it happens. Very high probability that this sudden flash crash is going to be reversed, and that is the process that we're in right now. So once we hit this, I will pretty much sell almost all of it. In fact, I will sell all of it and then look for re-entry. Okay. Because at that point, I have 20 S&P points from these levels here, right? From these levels that are alerted to buy. And from here to here is 20 S&P points. And at that point, I will basically not risk my capital for another 6-point move while I have roughly a 20 handle profit on my SPX calls, which would normally translate into roughly 200 to 250% or so. And at that point, I'd be out. Now, I'd be out. I'll be looking for an entry, which I believe if the market still wants to go higher, it'll come, retest this floor again, and then jump from here. So my real-time charts are always showing that. So the way I do it is I'm not going to look at a gift horse in the mouth when I'm buying these type of levels here, and I know there is a lot of supply here, i.e. sellers or sell programs, and when it comes to the high frequency trading algos at these levels, I'm not going to give them away my profit. So I'm going to take pretty much all my profits at that point, and then if it does break out, I will reevaluate the situation and see whether it's worth playing it for the next 6 points, or whether it pulls back a bit and then creates the support. Because if this support is not held, which is now resistance, and it'll become support once we get above that. If this doesn't hold, we have a fair shot to get back into. If this goes like this, great. That means the market the original trading band stays intact. But if we fall, you know what the levels are. First level of support is right there at 24.72. Next level of support is at 24.67, and then I wouldn't say the ultimate, but then a major level of support comes into play at 24.62. So, in a broader answer to your question that you asked, okay, is that volatility and the way the speed that the markets are moving, and I've noticed the speed goes higher every week, and these flash crashes, as I've depicted on these charts, Brian, are so recurring. I myself, I'm not used to it, but it doesn't matter because I am drawing the roadmap so that we know where we can fall and where we can rise. This is this is truly an algorithmic chart. This is not in any way or form a standard classic technical chart. 1 second. Okay, sorry. Some breaking news out of the UN and stuff, on the North Korea situation. So anyway, so bottom line is that, yeah, it's nothing bad. It's the same old rhetoric, coming out from the U.S. ambassador, as well as North Koreans haven't said anything, but it doesn't matter. Let me see here. Yeah, these things matter, right? After 6 p.m. when futures start trading. So bottom line is that when you're trading these type of markets, the first once you get into a base level entry, well, the first you need to basically capture. The movements are very fast, very furious. You can clearly see that repeatedly, and you need to basically capture most of the profit within the first 24 to 48 hours, and the intraday volatility is so intense these days, that it's, like I said, I'm not surprised, but I know very well that it's not manageable if you have a larger position in play, and you're up a decent sum of money, and and like I said, one quick trigger, and it doesn't even have to fall that much. It falls, let's say here, your profits just disappear, whoosh, out in the air, right? Yeah, so that's a totally different thing. Now, saying all that, what I do know when it comes to individual stocks per se. Oh, one last thing on this particular chart. When this type of volatility is going on, and this is the simple chart with just this price pattern. I'm obviously not showing the internals. I'm not showing the quad algo version, with the slow stochastics moving higher, whatever. But generally, in these type of situations, instead of shorting, I basically look to cost average down and looking for a price point to exit with the maximum profits, because I would have brought my cost down, to a pretty decent level. And so this type of volatility, this one, between, let's say, this band of 2467 down to 2460, where I'm continuously seeing, as I saw on Friday, a very strong, and on Thursday, a very a strong support base. I will use those support bases to cost average down and build a nice number of directional bets or calls on the S&P, in order to basically sell when we get to the upper end of this box. So that's something that's worked for me consistently, as you know. Okay, so instead of trying to basically trade this particular range, you want to use this as a optimal base to buy, lower your cost, or increase the number of calls that you have, increase your position, and then look to sell once we hit these levels. Now, with all the external factors that are happening in the markets and stuff, I don't know if we are going to, and we're going to find out very shortly at 6 p.m. Especially with the North Korea development and us flying the B-1B bombers over it, all that stuff. I don't know particularly how the markets will react, but generally what I know, the markets really don't give a hoot. The reason they don't give a hoot, because they know, and this is all, sort of political game theory stuff. They know very well, Brian, that South Korea being right there, and South Korean contacts are in direct contact with the North Korean regime too. The fact is, they are not going to go into a full-scale nuclear war. It's just way too many people's lives are at risk. There are more than 40,000 U.S. soldiers there, that, and we have more than 100,000 U.S. citizens who are working in South Korea. It's a global hub for everything to do with technology and business and automobiles and stuff. The last thing I can imagine, is South Korea hell bent on starting a nuclear war with North Korea. It just doesn't make any sense given the proximity of the situation. Now, that doesn't mean that tensions are not going to be ratcheted as they're doing right now, on both fronts, to be honest with you. And the reality is that, markets, from what I've seen over the years, they kind of know. So they know that there might be a little firefight here and there, but there's not going to be nuclear Armageddon, in which case you want to do a massive swing short on the market and
Yeah.
and hopefully, and make some serious money. So saying all that, this particular chart that I drew, this is going to be the roadmap for this coming week. It's just going to be, that's it. There's nothing else that I need to really look at other than this particular one, where the lows on this are somewhere in that 2456, 2060 level, and the upper end is 2480, and then we can get a blast up towards 2488, which is roughly the upper end of the scale on the S&P 500. Individual stocks, completely different story, and we're going to take a look at that now. So, in summary, you cannot, when you're trading the SPX or the RUT, unless we are at some climactic lower levels, which we are not. We are on the upper end of a process, a what I consider to be a topping process in the market, a short-term topping process. Okay, because tops are not created in one day, and we're not going to be down. We're not going to be down for the next 4 months in a row. Just doesn't work like that. Okay, I've been in the market long enough to know it. So traders like to think like that, which is the most fundamental. This is beyond the mistake. It's actually a tragedy when traders think that markets are going to top and then all they're going to do is go down in a straight line. It just never, ever, it has never happened in U.S. history, not even in the Great Depression. Okay, markets don't go down in a straight line. Markets basically get this, and nowadays with all different sector rotations, the fast-moving algos controlling the market and everything, it's more of a it's more of a zigzag pattern. And then if certain indicators, which none of them have broken whatsoever on the weekly, not even on the monthly, on the weekly charts, on the S&P 500, which I've explained very clearly, then you can stay on a swing short and say, okay, for the next 2 months, the markets are going to be going from here to here. But this is the problem. The problem is that what took hours, and I've written this down and I've said it to people, what took months or days now happens in minutes or hours. So my question is, you get a 600-point drop in the market or 400-point drop in the market, which we have gotten quite a few times. This normally in the old days, I mean the old days, this is talking years ago, would normally take about a week to 2 weeks. Now it's happening in 2 hours. So how the heck do you swing anything when it's happening in 2 hours? You got to capitalize on that breakdown immediately. And these type of 200-point type of moves or 100, 150 type of point type of moves, it would have normally taken 2 days. Now it's happening in 90 minutes. You know what I'm saying? So this is the new paradigm that I'm totally in the matrix, and I'm not kidding. Like, nothing surprises me anymore. So when sudden drops happen because of whether it be the Donald Trump Jr. fiasco with the Russian lawyer, or whether it be a mini tech crash that's coming from nowhere, and all this stuff, I'm just relying on my structured charts and said, okay, if it's getting there, I'm buying. If I see these candles, I'll go in for a quick short. And I know very well that which a lot of them do out there, do it all the time. All the traders, even the professional ones, they're shorting the market at these levels here, and then you get a massive hammer reversal. They're shorting it again. The market, the machines basically demolish them, and as they're getting burned, and from the short side, they're exiting their shorts with losses. They drop it again. Okay, by that time they're thinking, okay, this time it's really going to break because they're shorting it again. Nope. That's how these multiple bottoms are created. That's a matter of dogmatic shorts constantly getting hammered, and programmed buyers on the market coming in at those levels. So it's a combination of both. So when it comes to the short side in this type of environment, unless I can determine, and that is my job to do, unless I can determine on my models that I draw, not just the charts, that there is going to be a fundamental shift on the downside, then I am not going to go in for a swing short on the market, which is going to last more than a day. Now my shorts are, my SPX puts generally 90% of the time are contained during the day, and if it hits my levels, that's when I turn. So it's a very different world that we live in, and it's not something that forget about you and me. I'm talking about seasoned hedge fund guys, and I still have a whole bunch of friends I still keep in touch with. They can't even friggin' trade these markets, okay? And we're still doing it. I mean, those guys just put their hands up and say, okay, forget it, not gonna do it today. So the only ones who are, no, I'm serious, okay? The average hedge fund return, and these are guys coming out of the best schools. These are the guys who are supposedly the rocket scientists, Brian. The average hedge fund return is 3.9% year to date. 3.9%. Now, forget about comparing with our returns. That's a different story. But Compare it with the S&P 500, which is up 9.6%. They're trailing it by 600 basis points. You know, unbelievable. And these are the so-called guys in the know. You know, so and then you have a couple of the stars, the bright stars of the hedge fund industry, okay, who are basically maybe doing 8%, 9%, and trying to just catch up with the overall indices. So what I'm the point that I'm trying to make is that tactical trading on shorter time frames pays a lot more bills than trying to basically sit and say, okay, we're gonna, because the best minds can do it. Because if they're so smart, and this has been going on for years, because what's happening with most of them is, we'll move on to another chart. What's happening with most of them is they're constantly going short on the market, and my charts are clearly telling me that the short trade is not there yet, and that's what we're going to cover next. Okay, so
Okay.
so in a long-winded way, but I'm always very straightforward with my answers. You cannot on if you're looking to capitalize on those big 2, 3, 400% type of moves, you two ways you can do it. Just to recap, you can buy, you can rebuy, lower your cost, not look at the charts till it gets to those levels that I'm showing, which has happened repeatedly, but in which case you cannot look at your P&L or the movements during the day. All right, and that's it, and that way you will actually do quite well. However, given the changing circumstances and the political dynamic, more importantly the yeah, more like the political dynamic. That's really where the most of the risk in the market is right now. Not the earning stuff. Earnings are running at almost 77% higher than consensus. I'm sorry, 77% of them are beating the consensus. So um, so that part is fine. So saying all that, let's take a so that's one way you can do it. You close your eyes and you head back, and you sit there till it gets there, or you cost average down and you get these big surges and you want to sell into the upper end of that surge, based on the numbers that I'm showing. Okay.
Okay.
Okay, now looking at this, and this is a critical chart here, which we had a very powerful positive divergence since let's look at the date, since the 24th, and the 24th was, these are things I look at. 24th was a Monday, so this was the low on Monday when the markets were at approximately 2465 on the E-minis. Focus on this, on the full stochastics here, and then we went up on the 25th afternoon, a day later. We hit a, we kind of got overbought. We pulled back a little bit, tried to go up, and we created a negative divergence. Market hit a new high at around 2480, but the stochastics were showing a slightly lower high. Whichever the case, more important than this was this: the fact that we were at 24. We were at 24. This is what a positive divergence is all about. 2460 or 63, and we hit a short-term bottom on the stows. Here we went as low. The futures were as low as 2456. That's roughly 7.7 to 8 points lower, but at the same time, we basically created a higher low. To me, this positive divergence is getting played out like it has repeatedly been played out over the past couple of months, going all the way back to May, which is telling me that the market wants to go higher. Now, if this comes down and retouches the bottom again, to me, it's second nature. I'm going to use that as a powerful double bottom to load up again, going into the options expiring August 4th. I also noticed there was a very powerful buy candle here on the E-minis, which, as a reminder, a lot of stocks that we trade, a lot of the ETFs, well, not ETFs necessarily, but the stocks that we trade are traded off the exchanges. So we don't always get the true volume on those particular, on those particular trading assets. When it comes to the E-minis, okay, when it comes to the futures market, everything is fully disclosed. So every single volume spike that you're seeing here, red and green, is a true number, not a fake number. So that's very, very critical for my determination to see what kind of activity is happening behind the scenes, Brian. And this is not true of individual stocks. We can see volume surges on individual stocks and stuff like that, but a good not a good portion, but a nice chunk of it, maybe in some cases 20% of it is 20% of it is hidden. It's not showing because it's trading on the private exchanges. That's, you understand what I'm saying, right? Those private exchanges.
Right.
Yeah.
Mm-hmm.
So bottom line is that those type of when it comes to one of the reasons I track the E-minis so closely, number one, because they are the first ones to react to anything, or not necessarily react. They actually carry. They are the first canary in the coal mine, good and bad. And number two, the volume, speaks to me a lot more. So saying all that, so far what I'm seeing here is, one second. What I'm seeing here is pretty clear. To me, these consolidation channels are all intact. Is very defined. These uptrend channels, very intact. Mix it in with the fact that I am seeing a nice positive divergence and a crossover up about to happen. I expect next week the markets will burp higher. Of course, there's going to be intraday volatility. I don't need to remind anyone of that. But looking at this pattern here, I am seeing, let me change the color. This is what I'm seeing. We're going to hit a roadblock right there at 2480. That's 10 points higher. And that roadblock is going to resolve itself by either a pullback to the 34 and the 50 moving averages, the red line and the orange line, and then another attempt to go to the upper end of this channel, there are two upper ends of this channel. We are not ever, and it just hasn't happened. You just don't do, unless something dramatic happens, like the tax reform proposal is actually spelled out on Monday morning, pre-market, line item, in which case the markets will be up 300 points. Okay, so that's a different story. But aside from that, I highly doubt we are going to get a moonshot from all the way here in one single swoop. That'll only happen. And these are all the sort of the macro factors which cannot be charted on technical charts. But this type of stuff will only happen a monster move of 200-point gap open on the Dow if we get one of these big material factors that are important to Wall Street and U.S. business announced right at the market open or during market open. All right, so that's right. Because there's 30 points from here to here. You're looking at roughly about 180 Dow points that we're going to open up. So say aside from that, let's be realistic. What will happen? If things are fine and futures open kind of flat to slightly higher or even down, doesn't matter as long as it's not like all the way down here. If the futures open down at 2450, that's a 100-point drop on the Dow Jones futures at 6:01 p.m. in 2 hours time. All right. So my ACS session, I always set it up for 7 p.m. because this way we know what the futures are doing, and that is possible. That is very possible. Does it mean that it's everything's just completely over? No, things are not really over, meaning from a standard uptrend level till we break this downtrend line here at approximately 2420, which translates into 2425 on the S&P 500. Okay. It's a very powerful line. Once this line breaks, we are obviously going to drop very quickly to 2400. At that point, the if you keep on hitting a repeated level, whether on the upside or the downside, repeatedly, it generally tends to get weaker. Just like, law of nature. You keep on hitting the
Well,
floor, and at that point, we are going to drop rather precipitously down towards the 2340. All this is obviously not going to happen in one day, but you're talking about a very short time frame. Well, the market is going to go through a severe correction on a short-term basis, because we closed at 2470. If we drop to 2340, okay, so you're looking at 130 points, right?
mhm.
130 points times 6, you're talking a 780-point drop on the Dow, which will make world headlines. And we are certainly going to be in that trade if something like climactic like that can happen. That will only happen if we get into an initial firefight in the Korean Peninsula. Just
Right.
letting you know, we're going to drop 600 points like boom immediately. But markets know better. And the bottom line is, I believe we're going to see very strong support here. And if we do get down here, you want to buy the market hands down for the initial bounce that's going to be worth about 200 points within a matter of hours. And that's a lot of money. We have done that quite often. It has to be very quick and not think that that's going to be a swing trade that's going to take you all the way up here. The initial short covering bounce of these very precise structured charts is going to be at that 2400 level, and at that point there'll probably be a failure if things are escalating, on the global side. But saying all that, let me show you what is the normality. I gave you the sort of the black swan event that might come about. Okay, the other part is, this is looking fantastic. We did a nice reversal on nice volume. No red candles on Friday. No red candles. In fact, the only red candle was the Thursday crash. You can see that right there. See that?
Right.
Yep.
Yes.
So to me, that stands out quite a bit. Right after that, there was a monster short covering candle, which was really monstrous, because you always have to look for a reference point. The last time I can think of was here, which was here, here, which was here, right?
Hmm.
So you don't get these. These are like, first of all, red candles when it gets like that, those type of capitulations, you instinctively want to buy it. Capitulative volume bars, which I show, are normally associated with short-term bottoms in the market, and you can see that clearly. Look at them. Okay, every
Now,
single, yeah. Go ahead.
I have a question. I mean, do you follow the hourly chart religiously? Is that
Yes.
like the main
Yeah.
proxy? Okay.
Yeah,
Okay.
yeah, and I'm gonna give you a little flavor of that in the next session. I'm gonna show you how you can manage your trades better and what time frames you need to follow and what I look at. Okay,
Okay.
but
All
today
right.
I'm giving you a broader view. So yes, you're absolutely correct. So I follow the hour chart religiously. I look at when I'm looking at a swing trade, I am religiously following the 4 hour. That is
Mm,
what the
okay.
hardcore traders do. The 4 hour chart is the closest thing to a daily, but it's got the juice of a short-term trade with the feel of a longer-term trade. Do you understand?
Gotcha.
That's the
Yeah.
four
Yeah.
hour. Exactly.
Okay.
Following the daily for shorter term trading is almost like, it's mind boggling, because it doesn't work. Because I
Mhm.
use the 15 minute, I use the 30 minute, I use the 1 hour, and then of course the 4 hour. But primarily, if I want to be calm, which I normally am, and during heavy volatility in the market, I'll be focusing very hard on my different platforms, each of them showing me a slightly different picture. That's another day's topic, okay? Because what Thinkorswim is showing me is a little bit different than what my visuals are showing me on my quad platform,
Mhm.
okay? And what is showing me on investing.com, which is the easiest one, easier on the eye. And lately, I haven't really used Warden, which is freestockchart.com, which I'm going to reintroduce, next month. So the bottom line is that between these three platforms, two of them are right in front of you. Um, I can make a determination what is what is going on. On the quad side, it's very clear to see that we had multiple reversals. Let's just zoom in here. This is really what's going on. So multiple reversals, and we could very well get towards the downtrend line, which is the 2478 mark. If we break above that, we are going to get a quick surge up to 2484, which is 2489 on the S&P 500. But you can see that as we are climbing these bull flag channels, we are constantly, the volatility has increased, if you notice, right? So the volatility is getting compressed. It's getting compressed, and at the same time, the chop is increasing. So when you hear them, the VIX exploded the other day. Yet, when you look at what the VIX did on Friday, it's not a direct correlation, but it is a correlation. It's just, it's compressed to the lower ends, which is very bullish for the markets. And the markets are getting choppier and choppier. But I can clearly see a direction as to what's going on. So here at this point, this is where I'm looking to take my first level of profits, because most of my calls were bought at around this low to 2460s, and I try not to overload on the calls that much these days, because the volatility is so intense that if I own more than, let's say, 6, 8, 9, 10 calls, my P&L gets whipsawed like no one's business on just that one trade.
Gotcha. Okay.
Case in point. Let's say, for example, you own 8 of the calls at picking a convenient number at $4. Now, these I don't like buying out of the money on the S&P. I like to buy in the money or slightly out of the money. Given this type of volatility that we are incurring intraday, intraday, all of a sudden I am basically down to 2 within an hour. Maybe slip a little bit more. So you're looking at, I'm down $1,600 on that one trade. My goal is to basically own more, as long as I can see these type of quadruple type of bottoms, like I showed you. It's obviously much more clearer on this chart, right there. This is what I'm talking about. Then I will add more. I will lower my cost basis, but I will not go gung ho. Because let's say I decide I know this market, I know it's going to happen, and those are the most dangerous words a trader can use. Let's say I add 8 more at 2. At this point, I have 16 at 3, right? I'm looking to get a double on them. You see that happen, on any type of move, which to the 4,800. I'm looking to basically sell them around 6. So you're looking at a profit of like $4,800. However, what I have noticed lately, and this is personal experience, that regardless of the price, the number of calls, if I keep on increasing them, unless they're lottos, that's a different story, okay? If I keep on increasing the number of lottos or the number of calls, I'm increasing my risk parameters quite a bit, because what if it didn't do this? Instead, this just decided to break down directly to the 150 moving average. My $4,800 that I average cost down, right, at that point is worth 1,600, and not a good feeling when at that point you have to make a determination whether or not the market's going to hold here or it's going to get there. By the time it gets there, it will be, at this point, the calls are worth $1. My average cost is 3. They can go as low as 40 cents, 50 cents, let's say, right? Now, if I find massive support and I'm caught in this trade, this is what's getting called caught in the trade. There's nothing to do, like boom, it just happened real fast, and we fell hard, and we hit that retest of that downtrend line at around 24.25 that I told you. So what would I do? What I do is I'm going to be looking at all kinds of stuff and deciding whether or not this is the optimal buy point, or should I wait here, because the panic might put us all the way down here. The panic, what do you call it? Where the stop's getting triggered. So at that point, I would, at this point, keep in mind that my calls are set for 2470, right? These were 2470 calls.
Mm-hmm.
Now, what I would do, at this point, if I'm forced to, it's happened here and there, and it's worked out very well too, but it's kind of dangerous. So if they're going to 50 cents at that point, I will really lump in quite a bit and then buy, let's say 20 or 30, because at that time it's cheap, right? They're cheap.
Right.
So let's say I buy at this point I have 16. So let's say I buy 34 more at 50 cents, which is roughly, and this is only a forced buy. I necessarily don't want to do this, but I'm forced to do it given the fact that the markets will have a sizable bounce from this level. So at this point, I'm spending another $1,360, right? $1,360. So and I have already spent 4,800. So just to be exact. So we got 4,800 plus 1,360. So I got $6,000 running in that one trade, right? So
Right.
let me clean this up. So we got $6,160, and we have really lumped up here, and we have at this point 50 calls, right? So our average cost basis is roughly $1.21, right?
Right.
Exactly. So when we do get this, and your average call this as $1.21, and then it makes a sizable move as it did here, that pattern symmetry, let's say gets done really fast. Let's say it happens tomorrow, giving you a hypothetical example, and you're going to get a sizable bounce back towards the previous breakout level. Now that's become a resistance. Your $1.21s will probably go to $3, if not more. So you are coming out a massive winner, and you're making yourself roughly, at this point you have 50 calls, and you make yourself roughly $1.80. And I'm giving the reality of how it happens. I would say quite often, but it does happen a lot. You got 50 contracts. You're making yourself $1.80. So you just made yourself $9,000 on that one trade, which you were not intending to do. I'm giving you what reality happens, different from a textbook. You made $9,000 on something that you did not intend to do. You were just looking to make $4,800 if it went a simple way, which was up from where you originally bought it, right?
Right.
Okay, here is the thing here. The fact is that unless you have a good understanding and you're tracking my charts and looking at my alerts, and I'm basically saying this, I'm basically showing pretty strongly that this level is going to hold in the short term, you obviously do not want to go ahead and cost average down. And if you do, and this does what it's supposed to do, which is have a sizable short covering bounce back towards the 2444, 2450 level, and I've done this quite a few times, this is where the tactical charts become the prophetic Bible. How about that? You have to basically focus on the charts at that point to a level, regardless of what your feelings are, what it is. Of course, mix it in with what I'm saying, what my thoughts are. But that's so without these type of charts, you will never be able to handle cost averaging down. I don't care whether it's 50 cents or 60 cents or 70 cents, and you would be making a pretty a big mistake if you're not tracking the charts to make those, to fill it, to dollar cost average. And of course, I'm basically, putting out the tweets out there and then make that type of money. So that, that in reality is why, well, you already know, but still why the charts are so critical. Now looking yeah, so go ahead. Let me answer your question.
Yeah, so an example. So last week, IWM, I was down, initially, I think the previous week, and then I was dollar cost averaging. And then when we hit 144, big winner. Okay.
Big.
But
I know.
And so I trimmed probably, I don't know, like 70%, still held on. And actually, when the market pulled back, that profit, the little profit that I had left in there, I basically stopped myself out and got out like roughly just shy of break even on the remaining amount.
Okay.
But I guess my question is that, you know, because you know, some of the options that we, you know, that you
Uh-huh.
tweet out, you know, they're maybe a little bit, like you said, slightly out of the money. Do you ever worry about, you know, dollar
No.
cost averaging on something that, even though it's not going to probably get there, like your
Yeah,
example, you're
yeah.
basically,
So
you know what I mean? Like,
I
because
know.
time is decaying on it, but
Okay.
if you
Here,
make that
here.
big move and you dollar cost average big, then you'll at least be able to get your money back
Yeah.
if you get out
So
at that
so
point,
here's the
right?
answer to your question. Let's talk about buying in the money, out of the money. When it comes to the Russell 2000, I always buy either in the money or 10 points out because let's say let's look at the RUT. Okay. So on the RUT, they normally move 10 to 20 points. Look at the fundamental swings on those charts, technical swings on the charts. They're quite large. All right. It's just the way the RUT works. So I will, if it's down here, which is always a fantastic buying range, and this is a more simple chart. I've shown more structured charts on the RUT. You are looking at, one second. Let me get all these lines out. Let me keep this simple. There are two parts to your question. And clear drawing set. Perfect. Okay. So as you can clearly see here that each of these moves are roughly about, this case 39.20. This is roughly 17 points. This is 20 points. This is 20 points. This is 20. And the drop here is 20. Got it? A little bit more
Correct.
than 20. So each of the RUTs, which I trade primarily when I'm playing that side, RUTs generally move in tranches of 20 points, period. Okay, this one was a little bit larger. This one was 14 to 30. This one was 30 points. So generally, you're looking at 20-point movers. So if it's the 1400s, if it's down here, I will buy the 1410 or the 1420 given where we are on that particular day. Remember, these are only weekly calls and puts, so we cannot buy them during the day, which is good, which keeps us a little bit more disciplined. So bottom line is I will buy the 1410 or I'll buy the 1420, all depending on whether I'm seeing any type of technical high probability reversal, which is in the form of these, what do you call reversal hammers and bullish engulfing candles and stuff like that. RUTs are extremely erratic. Look how erratic they are. Okay, so the money made has to be rather fast. Now, so in answer to your question, if I can catch these levels here, it does not need to go to 1410, 1420 in order for me to make money.
Right.
From what I see out there, a lot of traders and stuff, they have this assumption that it has to hit the strike for you to make money. That seems to be a fallacy that's propagated out there. I don't need to go to 1410, 1420. I bulk up here at the 1398, 1399, 1400 level. I don't need to get up to 1420. I'll be making money off the second candle, off the first candle. They start moving immediately. So I don't necessarily need to go to 1410, 1420 because my cost average is down right now. I still have a bunch of days left. These things are not moving in like a sort of a luxurious fashion. They're kind of moving very fast, as you know. And the move from here to here towards the 1410 level will give me 100% return on my money. So you don't have to wait till the strike price in order to make money. And this happens with stocks too. So I always scratch my head that why they say, well, it has to get towards the strike in order for you to break even. That's complete hogwash. It's never like that. We do it every day, right? When I'm saying,
Right.
when we are buying the 2460, for example, on the S&P 500, and the thing is moving to 2470, 10 points higher, I'm already got a double on my money. I don't need to, and let's say I bought the 24, if it's a 2470, let's say 2460, and I said, okay, let's go buy the 2480 calls. I normally don't go out 20 points, but from certain climactic bottoms, I will buy out of the money because I know that bounce is going to be sizable. right? What I call the
Right.
reflex bounce. So by the time it goes to 2470, I already have a double on my thing. So the first part of your question is the strike never has to be met. So
Well, yeah, yeah. I
yeah,
mean, it's not so much that I understand that the strike doesn't need to be met. I
go
guess
ahead.
I was just concerned with, like, let's just say this happened on Thursday last week,
Yes,
right?
yeah.
So like for example, the IWM that I was holding, the initial position that I was holding that eventually proved to be the wrong hold,
Okay.
I guess well, I'm just saying, like, hypothetically, had I been like, okay, or like, I'm going to step in and I'm going to start dollar cost averaging, I
Mm-hmm.
only have one more day for that to pan out. And I
Oh,
guess I was just
okay, okay.
curious.
Yeah.
I was just curious on, like, your
Generally,
strategy in terms of that
okay.
nature of it. Like,
Okay. So now
yeah,
that you put things in a context of time,
right.
if it's the next day and stuff, I'll take a flyer, but I'm not going to put too much money in
Okay.
unless
All right.
I see a real tactical bottom or tradable low in place.
Mm-hmm.
Okay.
Mm-hmm.
Aside from that, I will basically look at the following week. Now I tend to trade the SPX a heck of a lot more than I do the RUT. Now
Okay.
RUTs are fantastic, uh, and still believe are in line. As you know, when I look at this chart here on the daily, let's take a look at this. This says no. This is still a very powerful bullish chart. There's not one single thing in here which is telling me that it's really bad unless we breach well below the 5 week moving average. Yes, it's an inverted hammer. So what? We have had inverted hammers before. And so the bottom line is this inverted hammer still is not a bearish engulfing. In other words, it's still within the body of this previous bullish candle. See that?
Mm-hmm.
So
Right.
bottom line is, and I'm looking at it very simply. Sometimes you just got to glance at it. Is that you look at this here? This is not even overbought. It's there. It's still creeping higher, and I don't see any sort of major alarm sign from a swing standpoint. And when I draw, I can draw a sort of a quick line. We are still very much on a we are very much on a bullish a weekly bull flag. However, it is a rising wedge, and I'll be watching carefully this coming week to see whether this line here, which is the 1400 line, the 20 moving average, also very close to the 34 moving average, holds. If we let's say, for example, I don't like shorting the IWM either because this market has hit me more. Uh, let's put it this way: just because of the very very immediate fast reversals on any sort of drop in the market. Unless there is a tactical short at play during the day, I do not go overnight with the shorts.
Okay.
I don't, unless I see things changing. Now that's and now when I've tried to do that, I've lost money. And so I know I'm fast on the shorts, a little bit more slower on the long side. And this chart to me is still pretty damn good. But in answer to your question, if it's expiring the next day, if they're really cheap, you can buy a bunch of them. But it all depends on what the charts are telling me, and whether or not I should be bulking up there. But generally, best way is that if we are starting to see a move, um, you don't want to go next day. You want to go the following week.
A week. Okay.
You're gonna go the
Perfect.
following week, yeah. But saying all that, you could wake up the next morning and based on what was going on the day before, we got deeply oversold. You could get a major pop up, and then you'd be slapping yourself like, "Hey, why didn't I do that?" But there's no easy answer to that. That's just trading. You know what I'm saying?
Right.
That's just trading. There's no like, "Oh, that's what's going to happen." But okay, so let me just go a little bit. So I showed you this here. To me, what I see here on the hour is actually very powerful. It's a good thing that you brought the RUT to my attention. Is to me this is extremely powerful. Forget about me drawing the structures and the lines and stuff. You got a double bottom. You got a double bottom stochastic reversal. That's a plus 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 plus. Okay. This
Okay.
is this is a 1 hour chart. It's not a multi-day swing, but immediately your first level of contact is going to be right here, 10 points. 10 points. You got a major support level here, right there. And you're looking at the internals to get the early signal of what might happen. So the bottom line is that one of the reasons why this is going to happen, in my opinion, it's a high probability trade, is oil. Oil is moving. Oil is basically in a short-term bullish phase, which I had shown from about a week ago. That's why we're buying the oil stocks. You know what I'm saying? Or some of them.
Right.
Exactly. So, and buying Gush, GUSH, the ETF. So bottom line is that you could very easily, again, get 10 points on it, but you got to be quick on that. Because once above that, the max move is 1445, maybe a little bit higher. And they tend to just move straight up and down, as you can see. Straight up, straight down. But this I like, given the base level of where we are. This also happens to be, give or take a few points, the previous breakout level. And it's multiple, it's basically almost a, well, it's definitely a double bottom. There's no question about it. 1, 2. This, you understand this part, right? The simple stochastics.
Yes.
Yeah, the double bottom stochastics. To me, it just comes naturally. I look at it, okay, that's it. You gotta, it's a buy. Now the buy doesn't mean you sleep with it all the way up to 1452. It simply means that for the next 10 points, you got a pretty easy ride. If it blows past that, then you got another 6 points, and the RUTs then to deliver very nicely on the ROI, as better, and it's good. Now, looking at the overall pattern, I really can't decipher what this pattern is, to be honest with you. I mean, somebody can say, oh, that's a head and shoulder. Could be the head here, left shoulder. The right shoulder again goes to 1445. I'll take my 20 points from 1425 to 1445. Is it possible that it's the right shoulder and then it drops again? Absolutely. But so this is good. So when it comes to the RUT, you don't necessarily want to look at a 4-hour. Okay, the 4 hours giving you this is the way I'm reading the 4-hour, just so you understand. I'm starting to see it getting oversold, but it's not there yet. However, the Russell, this is pure robotic selling. This is not me and you doing it. This is just institutional selling. One of the reasons the Russell got hit was because the text got hit. So a lot of, so that was because whenever you see candles, this is pure candle reading. Whenever you see candles this symmetrical, right? Look, on the way up, it's not symmetrical. On the way up, there's big bursts, profit taking. It's kind of a different feel. Can you see that?
Right.
Exactly. Yeah, no, totally. You see, and here it's mechanical. That's institutional margin selling. That's when a small hedge fund just had their day and their week ruined because they had to sell out a chunk of their positions. Forced. It's called forced selling, right? This is forced selling and profit taking. So this is sort of the instantaneous drops, but these are the only two occurrences that I can see of institutional selling. See, it starts off little and then it starts to cascade, right? Now, the good thing is that on the 4-hour, we are starting to see the support coming into play of the 50 and 34. Now, here's the thing here. The Russell 2000 generally does not stop at the 34 and the 50. Every single time that you hit the 34 and the 50, you slip lower, giving you a fantastic buying opportunity. See that?
Right.
So bottom line is it possible that it's going to fall a little bit lower? I think so. I think I'll be looking to buy this. Basically, and it's going to be very quick because once it gets there, it immediately turns. The full stochastics are telling me that my reading is showing that it's not fully oversold yet. But this doesn't have to go down. This normally has to come down here towards the 40 level before it turns. These things you'll just learn by looking at the charts. See, the percentage K, the orange line, does not have to basically go all the way down. Get it?
Mm,
It's only the
got it.
white line, which basically on the full stows, which needs to basically come there. Now, when you look at that very quickly, it's telling you it's there, maybe it's a little bit there, and the ultimate buying trigger is when it turns, right? When it
Okay.
starts to turn,
Right.
and then it just accelerates. And so once you see the turn, once I show the crossover up, then you need to basically, because look, when it turned, and if somebody's looking for that crossover point, by that time we're already up on it almost 60%. Get it?
Right.
So the
Yes.
crossover doesn't happen after it starts to happen, and this is more of a daily chart. So it's not like an hour. I know it's not like what's happening in 15 minutes. But generally speaking, um, after the second day, um, that's when the crossover takes hold, and by that time you've already, normally we would be buyers here, as you know, so we would be up 60, 70 points, and you could at that point swing it for another 1 or 2 days, depending on what we are seeing. Aside from that, this is a total robotic institutional sell. In my opinion, that's a sizable buying opportunity, and that sizable buying opportunity should give you, like I showed, at least 10 points, if not 15 points. Do not
Okay.
expect, do not, trade, plan your trade thinking it's going to go back to the previous highs, because I just don't do it like that. Even though it looks
Hmm.
very symmetrical, it looks pretty symmetrical that this V shape is going to happen, but I'm not going to plan my trade thinking that I'm going to close my eyes all the way from here and not take any profits. I'll certainly be taking profits at the first 10-point move, and then maybe a little bit more of a overshoot. Um, that's what I'd be looking at.
Okay.
You understand what I'm saying?
Yes.
So,
Hmm.
so good. Now, coming down to, yeah, we covered this one. One second. Now, I want to show you very briefly, because I'm going to show you two other. One second here. I'm going to go pull up the SPX here. What time is it? Oh, it's 4:36. Okay, one second. We started approximately one. See, time flies when we're discussing
Yeah.
things. Yeah, it's already an hour and a half. I'm like, what? Started like 3:17. So this chart, I'm looking at this here, Brian. This is a 4-hour SPX. Um, the daily is, one second. Let me go into the daily, because there's so many different individual topics that are related to one trade, right? Your job,
Hmm.
your job, Brian, is not to dissect all of them. That's my job. But your job is simply that as we do these sessions and we continue a little bit longer, you will find out that all the stuff that when you're looking at something, you're probably going to understand it, like I said from day one. As long as you grasp 40% of the messaging that I'm putting through, you're going to be in fine shape, or at least be able to deal with any type of damage or sudden volatility that hits us during the day. Got it?
Okay.
So that's
Got it.
really that's really my goal. My goal is not to make somebody all these years worth of accumulated chart reading and trading and stuff. That's like me taking, you trying to train me and doing your job in 4 weeks. You know what I'm saying? And it
Yeah.
will just, won't happen. Yeah, I'm a smart guy. I'll pick up a bunch of stuff, but that gut intuition and that sixth sense and that that comes about, the reactionary. What do you call it? Um, reflex, the reflex, right? Like when we're driving
Right.
cars, the reflex. Suddenly, somebody comes from the left, your hands are reacting faster than your brain, and the car,
Hmm.
you just swerve to the right. It's the same thing with trading. But the more you do that, understand the tactical stuff, that reflex muscle gets built a lot more. Now
Got it.
that doesn't mean you have to jump on every single two-bit move, but your reflex muscle does build more, and that's the best way I can describe it. So looking at this chart here, this is a more of a, this is obviously a longer term chart, and looking at it from a daily perspective. Um, I'm sorry, I'm looking at it from a weekly. I had this originally drawn weekly. There you go. So keeping an eye on the price going forward on the weekly, there is no damage whatsoever. Period. Okay.
Hmm.
So what I'm betting we have, and there is another chart that I look at. I'll show it to you next time. It's called the Swing 533. You've seen me post it here and there. The Swing 533 chart is brilliant. It is very easy to read. It is a proprietary chart, by the way. So people have tried to copy it, like mimic it, and it never comes out the same way. A friend of mine had sent it to me years and years ago, and I just kept it. So bottom line is, and I keep on updating it. So on the weekly, it's telling me there's it's another 2 weeks of possible gains in between the volatility, right? But given the fact we are so close here to the mid
Right.
channel, I think we hit the mid channel, and that's how I'm moving with my thesis that the first week of August is where we start to create a decent top, which would be in that 2500 range. This chart is very easy to read. You can see that. You see that mid channel?
Yeah.
Right there.
Yes.
Now the upper channel 2555 at some point or another, and this is something magical about technical analysis, will be tested. It will be tested. Okay, and so the upper channel will be tested 2550. It will certainly take that volatility move, maybe pull back a little bit, but every single metric that I can see here, the moving averages, the rising wedge, the channels, nothing, and even the stochastics, nothing is flashing a signal, a danger sign on the weekly, mind you. Does it? No.
Right.
Because the more we zoom in into the 15-minute, the 1 hour, and all that stuff, we see a heck of a lot more volatility. But on the weekly, it's still telling us, and this brings us to the original question that you asked. So on the weekly, it's still telling us that we are going to head towards 2500 and possibly 2550, and it's going to happen. So that would be that's called keeping an eye on the bigger picture while you have your hands on the steering wheel, so you're trying to avoid the potholes that are coming along the way. But so far, this is still a very, very bullish chart. But I think we're getting close. I think 2,500 just psychologically is such a round number that they're expecting. I think we get some heavy selling there. But then at the same time, individual stocks do a different story. But we are. There's no technical damage here on this side. Last thing I'll show you is on the daily. The daily, we are starting to see a pullback, okay? And that pullback is going to be contained at the 2452 level, which is this line here, which was the previous high. See that?
Right.
25. And none of these lines, again, are at all in any way or form confirming or sending us any danger sign whatsoever. This is pure volatility, very similar to what we incurred back in June, and then the breakout. So this is what I'm watching. Now, this is a negative divergence. Now, negative divergence generally take days to play out. By the time that it crosses down, like it crossed down here, the market still went up for the next 2 or 3 days. See that?
Gotcha.
So
Okay.
negative divergence on the daily, and this is to keep in mind. Like here's a prime example. Here was your negative divergence. Okay, look, this is something key. This is the last thing I'll tell you, and this is what really happens. So everybody's looking at this type of chart, right? So they're saying, oh, there's a negative divergence. I'm going to really short the market. Great, try doing that. The negative divergence occurred right on this this day, right?
Right.
The S&P 500 was at, look on the right, was at 2368 on the 23rd of February, correct?
Right.
Okay. So let's say somebody saw this, and a lot of the bears are talking about negative divergences. I read a lot of technical articles. That's what they're talking about. So they shorted here. What happened over the following 3 days? The market went from 2368 or 2368 to hit a new high at 2400. Get it?
Yes.
So that move from 2368 to 2400 is 32 points, right?
Yes.
So 32 times 6, 190 points. Imagine if you were short.
Yeah.
Oh man, that's a painful feeling. You know what I'm saying?
Yeah.
The bottom line is it did. The negative divergence did work out, except it doesn't work out on the day that it shows up on your screen.
Yeah.
Got it? So here
Makes sense.
here is start. Now we're gonna get one more push. That's probably going to be in that 2500 range. All right, because look at this. This was a 38 point move, right? 192 Dow points. It was still negatively diverging, but the real sell-off, there was no crash. It was just a rolling sell-off, right?
Right.
Till it got towards the bottom. So let's say hypothetically this is replicated here. We get 38 points here. All we need is 28 points to get to 2,500, right?
Right.
So 24. So this. I'm sorry. If it's a replication, then we get 20. Let's say 30 points. Takes us slightly above 2,500. This keeps on negatively diverging, and then you get a pullback.
Right.
And I think that's what's going to happen.
Makes sense.
Yeah.
Mhm.
And so, because I've seen these things happen so often. So in the old days when I didn't know, when I was starting out on the old-fashioned technical analysis stuff, I was like, okay, this is not good. I can't buy the market here. It's negatively diverging, blah, blah, blah. In the meantime, yes, the market will correct, but it's still got a couple of days left. And I put out a fantastic article written by Oppenheimer's Schultz, okay, who's a brilliant guy. Read it. Exactly what I've been talking about for days now. That there's no exact date. That's a fantastic piece. It's on Twitter. It says there's no exact date on the day the S&P is going to hit the high. And read it. It's very, very, very well written. It's short. Easy to read. Now looking at the 1 hour, you're seeing that the stows and stuff are still wanting to go higher. On the 4 hour, it's kind of doing, it's kind of dilly-dallying here. So whichever the case, I'll certainly be alerting. But I just want to show you that example where just because something is saying it's going to come down, it just won't happen exactly on our time. Got it?
Makes sense.
Yep.
Yes.
And we have some big movers this week. We have Apple and stuff. God knows. I mean, Apple might get slapped.
Yep.
So I'll be doing the straddle, and we'll go from there. I mean, Apple could very easily drop 3, 4, 5, 6 points. I mean, that's really what Apple drops, but that's going to rock the markets a bit, the techs again, and so it's very stock selective. Keep a broader picture on the market. Don't go overboard on the SPX calls or puts. Take staggered profits along the way, and try to keep an eye on the charts as much as you can.
Will do. Will do.
All right. So great.
I appreciate it, Frank.
No problem. And I look forward to working with you. We'll do it if on the weekday sometimes we can figure out a time. That'd be great too. Which should be after market, like around 8 p.m. So we can always do that. We don't need to wait a full week. You understand what I'm saying? So this way you're more abreast of it. I'll certainly be communicating with you on that. If you have any questions, you know how to reach me. And thank you.
All right. Yeah. Thank you.
Thank you,
Frank.
Have a good one. Bye-bye.
Thank you, you too. Bye.